So without further ado, I stopped sharing Stephen Burke, so you have a lot of great slides. So if anything on it, given those slides, the topic, and our crowd, you might end up starting at about 5 minutes late.
I'm going to try and go fast, so we'll see what happens. So we have so many debates in our country now. One of them is, are we debating the money being put out? Is that relief or stimulus? And I think it depends on which seat you're in, but let's just avoid those, the political aspect of it, and just talk about what's going on and what did we say is some of the impacts and what are some of the debates that are going on from an economic perspective, less from a political perspective, although it's hard to disconnect the two. But I wanted to just go back and how did we get here? Because it goes to one of the questions Zale asked last week, which is how do you explain the disconnect between the markets and the economy? And I think you have to think about the three big events that we've had over the last 20 years, starting with the tech bubble, which had Greenspan lower rates, into the great financial crisis, which really introduced the most unconventional policy from a monetary perspective we've seen, combined with fiscal stimulus. And then you had the great virus crisis of last year, which you really had QE plus, and then stimulus, the likes of which we haven't seen. But it is important throughout this to keep in mind what the Fed's role is. And it really is, their dual mandate has been maximum employment and price stability. And I think the maximum employment came later in the 40s, but it doesn't matter. Those are the two ones that people are focused on, and particularly for Jerome Powell, the view of that. What I would say, and I think this is an important nuance of Yellen shifting into the Treasury role, is that Yellen is a labor economist by background. And I think we're redefining what maximum employment is going to be as we move forward. And I think they're going to look at it not just on the overall numbers, but basically by subgroups, whether it's unemployment for women, unemployment for minorities, unemployment for different age groups. I think we're going to be redefining what maximum employment means, maybe not as a standard for what the Fed follows, but certainly what the intent of what they follow will be. And it certainly will be a bigger element from the fiscal side as to how we manage the unemployment issues. So when you go back to 2001, it's important to think about the rates were in a fairly normal range back then, where we're looking in the 10-year Treasury in the 5% range. 5 to 6% was really what the historical average for Treasuries has been. What you see now is we've moved them down to below what the historical average for money markets have been, which was around 3% if you go back in time. So a big drop in the early 2000s to deal with the aftershocks of the tech bubble. You saw it start to gradually move back up as the economy was healing, and then the massive drops that we've seen both in the great financial crisis and the great virus crisis. It's also important because housing was such a key driver of both the wealth of individuals in the US and also the economic activity of the US, that mortgage rates coming down as they have. And this is actually fascinating. If I took this chart back to the early 80s, for those who were around in the late 80s, you were getting, mortgage rates around 8% plus, 8 to 12%, depending on the time, those last couple of years. In the early 80s, it was even higher. Now we're looking at mortgages in the 276 range. So a pretty fascinating change in terms of what that means for the ability for people to access homes. But we also have to keep in mind part of the problem for the great financial crisis was that everyone was viewed to need to have a home. This is houses for sale. And you go back to the early 80s, the last time we had a big move up in rates, and you saw what happened. Then you go into the into the early 90s, again, a spike up in rates. Houses for sale went way up. When you went to 2007 and the great financial crisis, you really had people who were well underwater. So one of the things that the Fed was very cognizant of is not just increasing asset values for the wealthy, but since homes were the biggest asset value for most families, to get the asset values back and get as many homes that were underwater on their mortgages to move up. That was a big part of the push to lower rates to allow refinancing to make houses more affordable. It was also designed to stabilize the financial system, as the concern about banks through the derivatives being overwhelmed was another key element. So in context, this is all important to keep in mind. Why were the policies put in place by the Fed and by the fiscal authorities to deal with the crisis that we were in? One of the key elements was coming out of this by lowering rates and buying time for the economy. It let households have household debt service as a percent of GDP come down considerably, taking a lot of pressure off the consumers. And for a society that in the US that is about 70% consumer driven, an economy that's 70% consumer driven, this is fundamental to give them more dollars to spend and shift where their spending is going to more productive ways. So I think these are all important elements, but it's also important to see what we had in terms of the shift in the Fed balance sheet. And what you can see is for most of the time from the inception, the Fed balance sheet was very low. Back to 07, 08, we were looking at basically $850 billion of assets, and now we're looking at over 7 trillion. So this is the big shift, and this is the big question out for the future. And it also leads to the question, what are we doing to our kids and our grandkids? Looked at it differently just from 05 to give you a different scale. It's really fascinating to see going from under $1 trillion to over 7 trillion. And it's hard to believe that we're talking about a $6 trillion increase as if it's, what's required, and are we going to grow this even more for some of the stimulus that's still to come. So fascinating look at the balance sheets of the US and how much we've actually thrown at the problem. Why is that? Well, employment's one of the big drivers of it, and the unemployment numbers, and this goes back to right after World War II. So in the early 50s, you had just over 8% levels. Back into the 80s, which people never wanted to go back to those levels again. And lo and behold, in 2010, we came up short. But then you look today and we're much higher than this. This is one of the numbers the Fed's looking at. I'll talk in a minute about the other number and what's really driving the debate between Janet Yellen and Larry Summers. So the question is, go big, and how big do we go? And that's the 9 trillion plus question, because this is just the first stimulus. There's more planned to come to support the system. So many view this as the relief bill. And Yellen thinks if this goes through, we can get employment back down to 4% in 12 to 18 months, which would be where we were before the pandemic hit. Summers, on the other hand, takes the view that this is going to create too much stimulus, going to create too many risks and too much inflation without being targeted enough to deliver what we need to deliver. And will you solve the problems of the people that you're trying to avoid leaving behind? So I want to talk about this a little bit more and get into some detail and talk about some of the differences between 09 and today, and why we think that some of this is, there's merits to both sides. So Yellen's concern was about scarring and inequality. It's about that the needs are too great to not go bigger. And if we went bigger earlier, we would have been better off. And one of the lessons that central banks and governments took from the 09 crisis, the great financial crisis, was to act fast and act decisively. And they did that again this time. The question is, did they go too far? And when you look at these numbers, it's hard to argue that it was too much, or is it not enough? We have more to come. This doesn't count the 1.9 trillion, and it doesn't count proposals for infrastructure plans, which could add in total another $3 to $4 trillion to the stimulus that's been put at it, bring us well in excess of 50% for a GDP that dropped probably 3% last year. So let's talk about what's really driving Yellen's thinking. And a lot of this is around the U6 unemployment rate, which is really the broadest measure of unemployment, taking into account the total unemployed, plus those marginally attached to the labor force, plus those working part-time for economic reasons. So These are all funny calculations that you come up with, but just to give you a sense, the differential of this is looking like, we got up to 23% when you take into the full unemployment levels. You're looking at now we're only down to around 11.5%. What Yellen's concerned about is that 14.8 million jobs were lost due to business closures or layoffs from businesses that were struggling due to the pandemic. What Yellen's also worried about is we have big long-term unemployed numbers. So people who've been unemployed for over 27 weeks is about 4 million people, and it's been holding pretty steady there. That's a big concern because that's where the economic scarring comes in on two ends. You have people in their 50s who may not get a job again because they were laid off, yet they're going to live to 86, 87 years old. How do they deal with that? And what's the burden that puts on the system? And what does that do to mental health issues and other issues? On the other end, we have people that are in service areas that may not get jobs and don't have the educational backgrounds for it. And what do we do for them? So that's kind of where the go big right now scenario comes in from the Yellen side. From the Summers side, the too much stimulus is and too much potential for inflation is a key element of it. So let's talk about what he's really focused on. He's looking at a couple things. One is the job openings and the job openings against unemployment. So I'm going to give you some statistics that I don't have in the slides, so just follow along if you can. In October of 19, the ratio of those unemployed to those with job openings was 0.81%. In April, it went up to 4.63%, and now it's 1.62 as of December, so it's come back down. The concern is that the job openings are there, but the unemployment numbers are mismatched. And the worry is that the amount of money that we're throwing at the problem is having people being discouraged from even going back to work. And to put it in real dollars, if somebody was earning pre-tax $1,000 a week before the latest stimulus proposals, they would have earned about $22,000 over 6 months. If you're laid off, are collecting unemployment plus the $400 a week extra support, plus the tax credits, you would be earning about $30,000 for that 6-month period. That $8,000 differential is the concern that Summers has that's going to hold people back from looking for jobs. Now, is that a long-term problem or not? Hard to tell, but that also encourages people not to look. The longer you're out, the harder it is to find a job, and the further your skills deteriorate from being relevant in the system. So this is one of the big areas for debate. Another area is the amount of debt that we've taken on and what it's doing to the system. Just to give you a sense, we're about $360 billion of interest costs right now. If we move to 3% interest cost on that, it would double the amount of debt that we would have, debt servicing costs that we would have. So adding another probably $400 billion, you go to go to another 1% to 4%, and you're looking at adding $500 billion to debt servicing costs. And we'd still be at not really high interest rate levels. So that's another concern that we have to look at. But the real debate's going to be around output gap. And that's where the economy is to current GDP to what the potential of the economy is going to be. And one of the big issues comparing 09 to today is that in 09 we had unemployment rising. Today we have unemployment dropping, even though we have some bad characteristics of it. Back in 09, the output gap was about 80 billion a month, and it was rising. So the stimulus that we added was 30 to 40 billion a month then, so we short-armed it back then. It was only 50% of the shortfall. So that was back in 09. Where are we today? Well, unemployment's dropping, but we have some stubborn unemployment. The Congressional Budget Office is projecting that as of 12/30, the output gap was 50 billion, heading to $20 billion a month. So the stimulus we're proposing to add is about $150 billion a month, or 6 times the expected output gap. So that's where Summers is coming from, the concern about inflation. So you have different employment picture, different output gap, and there's concerns about the disincentives to go back to work. So we have a view that we're going to be in a situation where this debate's going to rage for a while. I think Summers, who would be more aligned to Yellen for most of their careers, is now taking a pretty divergent view. And it's going to be interesting to see how this plays out. We heard last week from Jay Powell at the Economics Club that he is not in the camp of worrying about inflation. We've been running at pretty significant levels below targeted inflation for a couple year period now. Inflation expectations have been coming down on a quarterly basis for some time. So I think there's a bit of a misperception about the stimulus, and I brought this up last week. The economic stimulus that was put into the system starting back in 2000 was designed to help the housing market, not for the high end, but for the low end people who are underwater on their mortgages. That flowed through to the great financial crisis, where we had to start lowering the prices again, lowering interest rates again to stimulate demand, to create a growth in the economy. It was also designed to inflate asset values, but not just for the wealthy, but for those owning homes, so that they could become above water on their houses and have a shot at improving their net worth and their incomes levels, and to move up in their social stratosphere. We've had a carve out of the middle class. This is exacerbating that, but they're left with bad choices. It's really it's fascinating, the experiment we're under. We think the government didn't have a lot of good choices. They should have moved more in 2009. They may be moving too much now, but it should be more targeted, to target the people, particularly in the minority category, and the working single mothers that are being laid off, to help them deal with the relief issues. And on a stimulus side, we should really focus on the things that we can all agree on, which are the need for infrastructure spending, the need to invest more in education, the need to take care of our digital infrastructure and the like. So there's places where we should be spending. But if we do 1.9 trillion now, untargeted, followed by an infrastructure plan, that's probably going to have some pretty bad unintended consequences as we move forward. So with that, Mark, I'll stop there and be happy if you just move to the other without taking questions, if that was okay. But no, I'm happy to take a question or two so we can get to the cannabis one.
No. Now you've assured that we're gonna have extended Q&A now that you've said that.
Well, you can cut it off.
Yeah, super presentation, Stephen. Really interesting. It is amazing that you can have Yellen and Summers on opposite sides of the stage now. Quick question. I was scribbling the notes and maybe I missed it. On the output gap, what do you think they're looking at as far as the potential?
Well, actually, the number is, let me just pull that down. They're looking at, we're 20 billion away from where we should be now in terms of the gap. So we're not that far behind potential right now. The problem is not the total economy. The problem is the subsets of the economy, and how do we provide the relief to those most in need, and not do it in a way that creates this disincentive for the capitalist system to work, where people want to work, they want to be gainfully employed, and they want to have the benefits that come with being successful. So, we're talking about throwing 150 billion a month. What they're seeing is a 20 billion a month problem now.
Stephen, how confident are you on the unemployment numbers that you used? That's always a moving target, at least in the past.
Well, they're government numbers, Jim. So I guess the answer would be they're the best we have. I think they continue to fine tune them. I think what we have a problem with is looking too much at the aggregate and not enough at the composition of them. And I think to deal with the inequality issues, we have to be much more targeted in what we do and be more thoughtful about the debate in taking it down to the right levels to provide help. Because I truly believe that the vast majority of people want to work, they want to be successful, and they want to have, they don't want to rely on the government because you can't rely on them for extended periods. So I would expect that we're going to get more targeted in looking at the composition of the numbers more carefully. And then your question becomes even more relevant, Jim, of how good are those numbers at those levels?
Stephen, amazing, always amazing. I look forward to this, best part of my week.
Sorry.
No, really, it's just amazing. I want you to comment on something because you mentioned the gap, wealth gap, and the government trying to deal with the wealth gap. I was listening to this podcast. You know, women have a 30 cents for every dollar to invest that men have. And then Black women and brown women have 1 cent to every dollar. And so it seemed, and this was a lady that runs some sort of organization for women to invest. So to help women invest, and that's where her focus was. She used to work for Citi, used to work for some of the other big banks.
Dale, what's the question?
How is this gonna, how much of this driving of the asset, increasing the asset value for people who don't have assets and increase their wealth is going to be affected by all of what they're doing now?
It's a great question that deserves a much longer answer than I think Mark's going to allow me time for. But I think some of it will go a long way because when you're helping the broader economy, it does allow for job creation to come, which will help them indirectly, not directly. But clearly, if you don't have assets, you don't benefit from the low interest rates. You actually are probably hurt by it because what assets you have, you're probably putting in savings, which are earning nothing. It was designed to really build the overall system, strengthen the overall system to let the weak areas get pulled along. But what we have to do is start targeting those areas that need the greatest help faster. So, and that's where getting a more targeted approach is going to matter. So I think it's not going to help them as much directly. It'll help them indirectly in having greater opportunities for jobs and better jobs.